All right, now on to our next panel. Sometimes journalists, unfortunately, leave people with the impression that they are know-it-alls, and I definitely am not one of those people. There's a huge number of folks who I rely on all the time to help set me straight and help me understand the construction supply industry that I've learned to love so well. And one of those people is Michael Collins, partner and managing director at Building Industry Advisors in Chicago. An all-around wonderful guy, except for maybe his love of the Chicago Cubs, which to this Washington Nationals fan can be kind of frustrating. But in terms of helping me understand the world of mergers and acquisitions and how to sell things, he has been invaluable, and I hope he's been totally just as valuable to you through his role as the writer of our Big Deals column in Pro Sales. And so Michael has, for the last couple of years, graciously agreed to host a panel on mergers and acquisitions, and it's turned into, I think, one of the highlights of the entire show. And to that end, Michael, I think, is going to do a great job again. I honor and welcome his participation in this and value him as a friend. Michael, come on up and let's get started.
Thank you, Craig. Appreciate that, and obviously the feeling is very much mutual, and appreciate our association with Pro Sales and being part of the conference. Welcome everyone to the M&A panel. I'll ask our panelists to please join us on the stage now and get themselves settled in. I want to just make you aware of one difference that we're doing today versus previous sessions. I will be keeping track of the questions that come in on the automatic feed. So you'll see me up here looking at my phone. I am not buying movie tickets. I am checking the next question. So there's none yet, so I'm caught up. Let's hope I can keep it that way during the presentation. Feel free to log into the app and ask those questions as we go along. So I think our panelists probably need very little introduction, but we'll have them introduce themselves in just a moment. I do want to start off with some slides that we cover every year to give a very high-level view of the activity in the M&A segment, in the LBM segment, as to how much activity we're seeing out there, what's going on. We get asked the question a lot in venues where it's a little more difficult to give a specific answer. What are you seeing out in the market? And these slides represent what we're seeing out in the market. Taking a look at the first slide, I want to point out that when we analyze these numbers, we look first at deals as a deal, so that one deal is one deal. Then we look at deals that might involve 100 locations or 300 or 400 locations, and we count those separately, so that on one hand, a big deal doesn't swamp all of our statistics, and on the other hand, a big deal isn't treated the same thing as a single location deal. It gives us a sense of the tempo of the market. So what you're seeing out here is that we had a big year in 2015, a big surge in the number of locations acquired because of the acquisition of Roofing Supply Group and ProBuild. That pushed the number up that year. It fell back in 2016. Would have been hard to repeat that year back to back. And we've seen the number of locations acquired grow this year. And we'll talk in a moment about what we've seen in terms of the number of deals completed. The other aspect of the industry that we like to keep track of is the greenfield opening of new locations. And there are companies in the industry that will greenfield and then will acquire, or some only do one or the other. That's always a very unique decision to each company. So if our panelists want to comment on that, we'll get some feedback from them on that as well. Closings are not much fun. We'll talk about those more in just a minute. And relocations, the only point I want to mention on that is that having talked to some companies that have relocated locations for whatever reason, the lease came up and the landlord wanted to do something else with the facility. Relocating an LBM location is nothing to take lightly. There's a lot of pre-planning that needs to be done, and I think that's the reason that you see so few of them. People prefer to stay in the spot that they're in. Taking a look at acquisitions by state, there are certain states that very interestingly are not only the site of the top 10 states of acquisitions, but they're also the site of the top 10 states by greenfield locations. So that's a way for the market to say, we really love these states. And the blue coding indicates states that are in the top of both lists. So as you can see, 8 out of the 10 states that are listed here, and some of them are what we might expect: California, Texas, Florida. My own home state of Michigan, I was glad to see that make a positive list for a change. Michigan's markets has lagged some of the other states. But the point is, these are some of the states that are of the most interest to acquirers, whether they're buying or greenfielding a location. So then we took a look at it and said, okay, well, just across all states, based on acquisition of locations and then greenfielding, are there states that just seem to have the preponderance of their activity from acquisition rather than greenfielding? And only Michigan appeared on the list again, and the other states are states where, for whatever reason, the market seems to prefer to buy in that state rather than greenfield. Now, in the case of the Dakotas, maybe that's because it's an energy play and they wanted right in. They didn't want the time and scale up of a greenfield. Hawaii, it might be land use restrictions and the scarcity of locations to acquire. Whatever the case, there are certain states that seem to lend themselves more to acquisition than greenfielding. Now, I mentioned closings. Obviously, a closing is not what we want to experience. It probably means that a location was not profitable, was not successful. And if you think of the many thousands of LBM locations around the country, to have only a couple of dozen of them close in each of the last 2 years is really a statement of the health of the industry, and it's a very positive statement. So not only have the closures dropped, they were at a very low number to start with. So we're not seeing a lot of locations be closed. So then we take a look at acquisitions as a proportion of total activity compared to greenfields. And as you can see, this is an industry that likes to buy companies, likes to buy locations rather than greenfield them. We've talked to companies that will open a greenfield location or move a location, and they say, well, I learned one thing in that process. I'm not ever doing that again. And so then they are an acquirer after that rather than a greenfield opener. And as you can see here, the numbers bear that out, that this is an industry that acquires rather than greenfielding. Now this slide takes a look at locations acquired versus deals completed. And so we'll get the question once in a while, well, it seems like deal activity has slowed down. In terms of the number of deals completed, there are fewer deals that were completed in 2017 than in the previous year. There were more locations acquired because of the mixture of large acquisitions that took place during the year, but on a deals completed basis, that number did drop. Now, I think you're going to hear, not to put words in their mouth from the panelists, that there's an active buying appetite out there. We're certainly in touch with a lot of companies that are active buyers. So it's not that there isn't interest in it. It's more a situation where the deals have dropped off because there are not as many sellers as there were previously. Quite frankly, people are making money again, having fun again, and indicate, I'm going to stick around for another year or two. And so that's a decision everyone has to make, but I think that's the main reason behind the dip in the number of deals completed. So we were curious to know, what kind of companies are being acquired? Are they, how many of them are single location businesses where they had just the one location, and how many are multi-location businesses? It turns out that in any given year, about 60 or 65% of acquisitions are single location businesses, and the remainder are the big mega deals. So by number and by amount, there is a lot of buying activity that goes on out there on a single location basis. And when we've looked at the numbers over the years, it's not all done by the big acquirers out there. It's done on, a lot of times, companies that will only ever buy one company in their lifetime, the next neighboring business, half a state away, and that's who's out there doing a lot of this buying activity. So it's very broad-based. Then the final two slides that we wanted to take a look at, just to ask the question of who are these buyers and who are these sellers? And as you can see, on the buyer side, about 56% of buyers by deals completed, were lumber yards that were buying other businesses. And we'll see in a minute what type of businesses those were they were buying. Now, the difference between a specialty dealer and a lumber yard is pretty clear cut. A specialty dealer will be someone that focuses on roofing primarily or drywall primarily. When you look at these numbers, the diversified distributor is very gray compared to a lumber yard. A lot of times that's just simply a business that doesn't seem to lead with lumber as a key material in the market, or that doesn't sell it at all. So there's a little bit of judgment there. You could almost make that one wedge of the pie. But the point is, the majority of acquisitions are being undertaken by broadlines distributors. And then the last slide to take a look at is who are these sellers? And exactly half of the deals were, again, broadlines distributors or lumber yards, And then about a third of the deals were specialty dealers that are your roofing suppliers and drywall suppliers that are deeply focused on one segment. And I counted in that category a dealer that is focused mostly on exterior products. I didn't consider that fully diversified if they didn't also do interior products. That was considered a specialty also. And then hardware distributors and manufacturers round out the rest of the group. So from our standpoint, there's a lot of activity out there. It's very diversified. It's a very diverse set of buyers. We've got a great handful of buyers on the stage that have done some activity in the past. They share their experiences with you. But the point is, it's a very broad set of companies out there today that are making acquisitions. So without further ado, I'll ask each of our panelists as we go along to both introduce yourself, if you would, and then just give us at a high level your company's general acquisition experience. And that can be in terms of the number of deals you've done in the past, or just something to give our audience members some sense of your acquisition background. And Chad, we'll start with you.
Chad Crow. I'm the CEO at Builders First Source. We haven't done a deal in 3 years, so I'm not sure why I'm here. But we bought ProBuild in 2015. Prior to that, we'd probably done about 30 acquisitions.
That's why you're here.
Been on the sidelines since the ProBuild deal, digesting that elephant.
Right.
Yep.
Right. Thank you. Welcome. Dave?
Dave Dittmer, CEO of Tal Holdings in the Pacific Northwest. We started 2017 with 3 stores, ended with 8. It exposed a few weaknesses, and we're spending time in that process. Those 5 stores were 2 acquisitions, 1 4-store chain, and 1 single location.
Thank you. Steve?
Morning, my name is Steve Swinney, founder and CEO of Kodiak Building Partners based in Denver, Colorado. We've done 14 acquisitions since 2011, which is when we were founded. We have 53 locations across a pretty broad base of building material distribution. We'll do about $800 million in sales this year.
Hi, I'm Ruben Mendoza, founder and CEO and president of Foundation Building Materials. We also started in 2011, and we've done 33 acquisitions, have 228 locations, and about $2.2 billion in sales. We are a specialty building products dealer.
Yes. Welcome, everyone. Thank you. Well, last year, if you were here, you remember that the theme of our presentation was 6th inning strategies, because we felt that there was a consensus that we were in about the 6th inning. I'm curious to start off with an extension of that theme and to ask the panelists if you had to continue with that baseball metaphor that's easy for all of us to get a hold of, what inning would you say we are in now? And do you feel this is a good time to be a buyer in this market?
I'll start. I still think we're in the 6th or 7th inning. I think there's a high probability it's going to go extra innings. Things still feel really good from our end. Do I think it's a good time to buy? Absolutely. We're on the sideline still right now. Our plan after we bought ProBuild was to continue to delever for a few years, and we're still we're getting to the tail end of that plan, but we're still on the sideline from an M&A standpoint right now. But I do feel like it's still a good time to buy.
Great, thank you.
I would say we're in the middle of the 7th inning stretch, actually. So I'm waiting for somebody to sing the song. But from my standpoint, I think there's a lot of, not necessarily hesitancy, but they're looking at what's going to happen. What are the tax law changes going to do? How long will this good market stretch continue? There's a lot of evaluation and analysis of that. So, but I agree with Chad. I think it's a good time.
Yeah, I'm just going to echo what they said in terms of timing, and I agree. I think we've got a long way to go in terms of a solid, stable economy and market for what we do. We've had now probably 10 years going of underbuilding of homes, and so I think there's just there's a lot of positive things to look at out there, and as we all look at our businesses, and certainly. On the question about acquisitions, I hope it's still a good time. We did 3 acquisitions in the 4th quarter, so if it's not, we just made a lot of mistakes, and I don't think that's the case. And we've got a lot that we're looking at right now. I think this will be an active year for Kodiak from an acquisition standpoint.
I would echo the same sentiments in our industry. We did 10 acquisitions in 2017. We've done 2 in the 1st quarter. Got probably 3 signed up now. And so we are an acquisitive company, and we plan to do about the same in 2018 as we did in 2017. But I do believe like Dave said, we're probably in the middle of the seventh. I think Michael said, I want to wait another year, I want to wait another 2 years. When somebody says that to me, I say, I might not be a buyer next year or the following year. And I'm not just saying that. We might not be.
See, I took a chance asking that question first because they might have all said it was not a good time to buy and we'd have all just had an extra long coffee break. So I appreciate that feedback. Now, the audience will be glad to know that we've also made the decision this year not to dance around the EBITDA multiple question and pretend that it will not be the first question. I was surprised to see it's not already up on the app. We'll work backwards through the group, and I will ask you where you are seeing EBITDA multiples, because I know there's a curiosity about that. Feel free to answer that question in relative terms or directionally. Are you seeing them going up or down with a prediction? Not to corner anyone on an exact number, knowing there are different ranges and sizes of companies. What comments could you give us on that, Ruben?
So for us, it's throughout the last several years, it's been between 5 and 7 on a pre-synergy basis for us. It's public knowledge in 2017, we did 10 acquisitions, and it was a 5.7 times multiple average. Now, in 2018, the 2 deals we've done are a little higher than that, but not that much, below 6. And so, you see these mega deals where it's in the teens, or it's double digits, and those are mega deals. And when you're buying 1 location, 2 locations, 3 locations, the multiples are lower.
Yeah, so I think our experience has been probably similar, a little lighter than that, probably in the 4 to 6 range. When you look at the data that was presented a few minutes ago and you saw a big spike of activity in 2015, we felt like at that time the market got very overheated and a little bit too aggressive. We had done a lot in the previous year. We've kind of sat on the sidelines a lot during 2015 and 16 for that reason. I think what we see now going on over the last year is a pretty reasonable market in our view. I think we've had more success finding a place where we and sellers are comfortable and agreeable on transactions.
Yeah, the 2 deals that we have done have been small entrepreneurs. So you negotiate and arrive at a price, and you could calculate what a multiple is, but we don't really talk about EBITDA and multiple. We're negotiating on asset values and those kinds of things. So it is a number that we can deal with, but it is not in the forefront of a negotiating point of view with an entrepreneur.
Like I said earlier, we haven't done a deal in a while. I think we paid about 9 times for ProBuild pre-synergies. Post-synergies, it was basically free. It was awesome. That's a joke.
Nobody else got it.
That's great.
Never mind the 1.7 billion of debt we had. But before the downturn, when we were really active, it was probably in the 5 to 6 times range.
Right. Okay, great. There. So we got to that question right off the bat. Out in the market, are there indexes or certain economists or certain Fed reports or any? Obviously, we all watch the housing numbers, but what are the indices that you really pay attention to? And are there any that you're paying attention to now that you weren't a couple of years ago, either because you just discovered them or they're more relevant because of where we're at in the cycle? We'll work
The usual permit starts, unemployment. I guess the one that comes to mind that I've been watching a little closer is interest rates. Obviously, as the interest rates creep higher, rates have been so low, it's been an afterthought, but something to keep an eye on in the next few years, I think.
I agree with that. Additionally, we have 3 yards that are really second home markets. So we're talking to some of those contractors who might have 3 or 4 years out in front of them. So if they've got that kind of a portfolio that they're going to be building toward, we feel pretty good.
Do you mind expanding on that? When you say second home markets, what behavior does that drive differently in your company when you know you're dealing in a market where there's maybe more willingness to pay?
A lot of those builders are only building 1 or 2 houses a year. They're multiple $1-million homes. So if they've got a portfolio in front of them, we know that activity is still out there.
Oh, I see.
And those are people with discretionary income, obviously, that's going to build a second home in Friday Harbor on the San Juan Islands. So.
Yeah, I think in addition to what's been said, we watch steel prices, oil prices, the commodity markets outside of lumber. a fair amount because for steel, we sell a lot of rebar. And then we have a big presence here in Texas, so certainly the oil market affects some of our economies. And then I think population growth, population migration would be the one other thing I would add that we pay attention to.
I would second a lot of everything that they said. We've developed our own tool. We call it Moneyball. And we use John Burns Real Estate, we use Dodge, we use a number of factors, and we go by region, by branch, and we develop a 5-year outlook for multifamily, for single family, for commercial construction, and that's how we open greenfields, that's how we do, that's not how, but that's what we look at. To open greenfields, that's what we look at for certain markets.
Okay. So I should actually have pointed out that in a way, all of the questions today are coming from industry members because of conversations that I had with past attendees at this event. And so it was really meant to be focused on the questions that individuals in the industry would want to ask. So this one I want to state that it was asked from the particular perspective of, since if I am going to sell, I want the most value for my business. You, as a buyer, what is your ideal acquisition? What is the acquisition that you're willing and comfortable to pay the most for because of the characteristics that it has? What are those characteristics for you that, from a value building standpoint, our industry members can emulate and put into place in their business? We'll start with you.
Let's
Chad.
start with Ruben. I know he hates being
okay.
last every time.
There you go. Well, we're both kind of going back and forth. Yeah, go ahead.
I'll go first. I don't think that's a black and white question. I think sometimes you're trying to consolidate a market to get the number one position. So you buy somebody an in-market deal and you pay more because the synergies are better. There may be some consolidation in there, which is not great for some people, but it may play out good for the buyer. And other times you're trying to fill up some white spaces in the map for us, in which case you might pay a little bit more. But what we like to see, a lot of times their vehicles are older, so we have to discount for that because CapEx is going to be higher in the coming years. A lot of times their days outstanding are a little higher. And so, we buy usually an asset deal with a cash and debt-free, cash-free business. So you take the debt, you take the cash. And so all the cash conversion stuff is that becomes, we have a net working capital adjustment after about 90 days, and we set a target based on an annual net working capital of your company. So if it's over that, that's yours. So dead stock, slow-moving inventory, over 120 days, it becomes yours after the deal's done. So that if it's cleaner, it's better for the seller. I could go on for a long time.
Go ahead.
No, go ahead.
For us, I think I'd answer the question a little bit differently. Our strategy and vision for Kodiak was really a lot about embracing kind of the independence and the local nature of our industry. In our acquisitions, companies keep their brand names. We continue to operate in that local market, really as that company always has. And so for us, it's about culture, leadership, and being in a market that's got good long-term demographics in it. So those are the things, certainly the numbers, all the things Ruben talked about are critical and baseline kind of things that we've got to have in an ideal acquisition. But what really makes an opportunity sing for us is a culture that mirrors ours, a leadership team that we can really partner with and grow that business together, and then a market that we think we've got a lot of opportunity in.
Steve just read my notes, so. No, actually, culture is very important to us for a couple of reasons. One, most of our targets are going to be single entrepreneurial operations. But secondly, because we're a small company, we can't afford to make an acquisition mistake. So if that culture's not right, now then we're pushing that rock uphill, trying to convert it into our culture, if you will. Asset management is important to us. People are important to us from a leadership point of view as well, because we just don't have bench strength that we can go in and replace key people. So we need that bench strength that the acquired company has.
Yeah, I'll echo what these guys have said. I'll add product mix is very important. value-add content. Are you pre-hanging doors? Are you providing millwork or building components? We always like to see that. Market share in a particular market is important to us. And then from a people standpoint, I agree with everything these guys have said, but I'll just add that some sort of succession planning is important. If you've got an operation where the owner is basically the only one that has all the relationships with the customers, that can be concerning. And then if you have a high concentration of customer mix, especially in the scenario I just described, it's concerning as well. So having a good succession plan and making sure others within the organization have good customer relationships as well is important.
So I'm going to graft an audience question onto.
I just wanted to add one comment in terms of excellence. All of you are doing an excellent job asking questions privately, so you're probably not going to hear me very much, but just to make sure you understand, Michael can read all your questions up on the podium and can then put them to the audience. So keep it coming. You guys are doing great.
And I'm going to do that right now. I'm going to graft one of the audience questions onto one of the questions that I was planning to ask. The other side of the coin of the ideal acquisition is, what is the no thanks, walk away showstopper, or just an aspect of a company that will, for you, represent a serious impairment of your sense of the value of that company? And the tie-in with the audience question is, how long do you expect an owner to stay after you acquire a business? That being one of the things that can improve or harm the value of a company. I'll add that as a specific element. So if you could each comment on that specific element, and then generally what are the detractors from value?
Yeah, we've talked about some. First impressions are important, so keeping your facility clean, your equipment in good shape, your records clean, I think is important. Culture's important. As I mentioned, succession planning. Typically, in some cases, we're happy for the former owner to stay on as long as they want. It's kind of a case-by-case basis. But I would say, at a minimum, a year and a half, 2 years is probably what we would prefer as a minimum. But again, we've got former owners that have been working with us for 15 years. It just kind of varies.
We're not turnaround artists, so that would be a detractor for us. In terms of the owner, what role do they play? And when they leave, because obviously there is an end date, who's going to take that vacuum? Who's going to do those things that the owner used to do? So because he or she probably is the culture driver, and as Chad said, if they're involved in sales, if they're involved in purchasing, all those kinds of things, we've got to be able to mine what that whole thought process is, not necessarily because we want to duplicate it, but because we want to understand it.
I think as far as the red flags kind of question, I'd say turnover, customer turnover, employee turnover. Either or both of those being very high would be a huge red flag for us as to what's really going on in that business. I think certainly not having really clean books and numbers are a detractor for two reasons. One, it just creates a lot more difficulty in the process of both sides getting to the right number and getting the deal done. But I think secondly, it's about credibility and confidence. As buyers, we're coming in and getting to know your business. And when things keep changing, or, well, you said it's this, but it's really that, obviously that creates a lot of doubt and concern. And as Dave said, I don't think it matters what size you are. You don't want to make mistakes in this. These are big transactions no matter what, and you don't want to make mistakes. So when there's a lot of that uncertainty, I think it creates a lot of question marks. So I think as far as the question about owners and when they leave, when they stay, for us, we really are a family of companies. We've built it that way, and frankly, most of our sellers and now operating leaders today are one and the same. Most of our sellers stay and become part of Kodiak. In many cases, they become investors in Kodiak, and we continue building a business together. Certainly, eventually, we all want to probably retire at some point, and so we kind of go in trying to understand what is the time frame for that seller. It's much more, the process is much more guided by what are their interests, what's their roadmap and their game plan, and then if that game plan is retirement in the semi-near future, we're going to have a lot of discussions about the rest of the team and what their succession plan is, and do we have a good a good next generation stage for that leadership.
So for us, it's a lot of the same. Culture is a big deal. We've passed on not plenty, but a handful of acquisitions because, I could tell right away we just aren't the same. We have a set of values or culture, and we run our business by it, and it's not just some BS statement. We run our business by it, and if we can't match up with somebody, then it just doesn't work. And so, and secondly, as far as customer concentration has been a problem in a couple of acquisitions. One customer's 30, 40, 50% of the business. And I've actually asked for a supply agreement in some of those and didn't get one and didn't do the deal. So customer concentration's a big deal for us. And I can't remember what the other stuff.
What's an example of a cultural, I think we all talk about culture a lot, and tell me an example, Ruben, of not a company name or anything, but an example of a culture item you identified that you said, that's a thing that's cultural about that company, doesn't fit with our company.
I was contemplating telling you a company name. So Guy, we talked to a guy, and he's a guy who, they're in the LBM business now, and they're big. And when we talked to him, I could just tell. He's a business guy. I don't know if he's completely straight up, and so I didn't trust him. And so it just wouldn't work. If we can't trust each other, it just doesn't work. And so, they're in the business and they do a lot of business. And so we just passed. We just decided that wasn't a fit for us. And that's just it was a trust issue there. And another guy is kind of a brash, arrogant guy, and it wouldn't fit. So we just, no thanks.
Thank you. So this question I'm going to throw out to the panel, and if you have an opinion on this one, please, give me a nod and you can answer it. This is an audience question. Where do you see Trump's tariff on aluminum and steel going? I was just going to say, and if no one answers, Steve admitted that he looked at steel prices. So, does anybody have a particular opinion on that? Obviously, nobody's on that committee. But.
It's definitely near and dear to our hearts. We do a little bit of business in areas that will be affected by that. I think there's already been some movement there in the past year. Things that have already happened have reduced steel imports substantially. Over the last year, it's driven up prices. I think that will continue. I'm actually not quite as concerned now because imports have already dropped significantly. They can't go below zero. So I think it'll continue to drive prices up. But I do like at least that the market knows it, they see it. Everyone seems to be absorbing that pretty quickly. I don't think it's great for our business. I don't think it's great for our economy overall to do it, but it's going to happen.
On our end, we sell a lot of metal framing, and in 2004, it wasn't the same thing. It wasn't a tariff, but there was a shortage. We were on allocation. Prices went way up, and it was a big boom for our business. And I think that I think people are seeing this maybe as a big boom for our type specialty building product business, but overall, it probably would be short term, and but it gives us a short term good hit.
I'll take another audience question. We talk a lot about being the preferred supplier, and the question they have asked is, what do you folks do to make yourselves the preferred buyer? Obviously, money's nice, but deals come down to a lot more than money. So if someone's thinking of selling their company, what are the ideal characteristics of a buyer? What should a buyer be like to be an ideal buyer of a company?
Well, Chad said it earlier. He said a lot of and so did Steve, a lot of the ex-owners are working there, and I think preferred buyer is, let's talk to everybody else who sold, every one of them. And most of them are running businesses for us. And if they're not, they're retired, and their key people are running regions, they're regional vice presidents. There's so much opportunity for their people. Most people who sell want to take care of their own people that have been working with them for 10, 20, 30 years. And I feel like we've done a really good job at doing that. We care about that.
I think what I'd tell you, and obviously we're all biased up here about why we think we're good buyers, but For us, my first job to actually work out in a yard was 7 years ago. And my first job actually in this industry was in 2007. When I came into this industry after roles in various places, I just loved the culture and the environment that this industry had. And it really captured me. Several of us left ProBuild in early 2011 and started Kodiak. And so for us, it was really about embracing the culture and the legacy and the history of what all of you have created and your families have created over the last 20, 50, 100, 150 years. And so, so a core part of our strategy is, yes, acquiring and consolidating and growing, but it's growing and embracing and maintaining what's been created throughout the history of this industry. And so, from our perspective, I think, and I've heard from, some of our former sellers, who some of them are in the audience today, that's been really attractive for Kodiak, because it's a place where what their families created kind of for such a long time can come and be a part of and have stewardship that they trust will maintain what they've built and maintain the way they've treated their employees and their customers and how they've served their communities.
Dave, if I could jump in, when you answer this question, the part of the notion of calling this M&A Perspectives was to have, larger buyers, regional buyers, a mixture, different specialty, broad lines. And so if you could comment in your answer on the unique aspect of being the regional buyer rather than the large national big corporation type buyer or the large PE buyer or publicly traded buyer. If you could comment on that, please.
Like Kodiak, what Steve said, we've also kept the names of the companies. We don't have a reputation in those markets, they do. So rather than spend a lot of money trying to build our reputation, we'll use theirs, if you will. Natalia was recognized earlier for the social media aspect. We also think that legacy is important. We also think that history is important. We also believe that people are critical and work hard to take care of those people. One of the interesting cultural issues, if I can jump back to that, is how do they treat their people? What are their benefit programs? What are their bonus programs? What are their vacation programs? How do they take care of people? And if that can align with what we're trying to do, then that's an easy discussion with the owner, that you're doing what you're doing, we're doing the same thing. I think the other thing that's interesting about this business is Steve's in the yard 7 years ago. I was in the yard 47 years ago. And we're all in this business, however. It is a relationship people business. Technology hasn't swept in and removed any position that I can recall. As a matter of fact, it probably added some positions. But the fact of the matter is, we are relationship business. Technology is changing it, perhaps, that's true. But we're still handshake, face-to-face, deal with our contractors, deal with our suppliers. Interestingly enough, the four of us are middlemen, if you will. We're buying from a distributor network, we're selling to a contractor or homeowner network, we're someplace in the middle. Many middlemen, if you will, have been eliminated over time. We're one of the few last standing middlemen in my mind.
Yeah, I agree. I mean, the people are the key to this business, and hopefully they always will be. I think one thing we try to do is just be as transparent as we can. Unfortunately, when you sell your company, some things will change, but I think as long as you're clear in the communication, and we've learned over the years, if you are going to make changes, do them relatively quickly. That's when people are expecting the changes to happen. But just be clear and honest and transparent, and we encourage people that are considering selling their business we give them references of people we bought most recently. Call them, see what they think, see what's good, see what's bad. We are different. We are a large public company, so that does change a few things at a location level. But as big as we are, we still try to give our locations the autonomy they need to run their business, because every market's different. And if you take that away from them, it can be very detrimental. We've learned the hard way over the years where we've made some mistakes and it doesn't work. So it's just like these guys have already said. It's just about treating the people fairly. It's probably one of the most difficult things you deal with as an acquirer is these changes. Things will change. Some people adapt very well to change, some people don't. And at times, that's probably the most heartbreaking side of it, is you see people that just aren't willing to change, and unfortunately, some of them don't make it. But we've also got plenty of examples where people have thrived, and really being part of a larger company have had opportunities that they otherwise wouldn't have had. So.
We've talked a lot about aspects of companies that will increase value. We talked about some aspects that will decrease value. Setting aside any of the major deal killers of culture or something that is for you insurmountable, set that aside and think of a company that has some things about it that need to be fixed and improved and changed. It's below average margins, or there's some problem with that company. Do you prefer to buy companies with a little bit of challenge to them that let you improve the company and have some low-hanging improvements to make, and maybe the valuation reflects that there were some improvements that needed to be made? Or do you want to buy businesses that are already dialed in and humming along at a great level? And we'll start with Ruben.
For the most part, we'd like to buy businesses that are humming along and doing great. We're not huge turnaround, but we have bought businesses that are struggling as well. And that would be less than an EBITDA multiple. That's more of an asset purchase. And that's more of a close the branch down and merge it in with ours. We did that in Western Pennsylvania. You know, two companies were fighting it out, and these guys were struggling. As a matter of fact, they were financially struggling, paying their vendors. And we went in and bought their assets and gave them like $100,000 in goodwill, and operated out of there for a month or two and moved some of the people into our location. And you know, the guy got to get out of there with at least his assets. And it worked for us because the margins went up because nobody was fighting anymore in the market.
So, I heard a minister say one time, don't ever, if you're looking for the perfect church, don't come here. None of us are, and if you're a perfect person, don't come here because we'll screw you up. I would say that about us. We're not looking for the perfect company because, one, it doesn't exist, and if it did, don't come join Kodiak because we'd probably mess it up a little bit. We're not perfect. But we do look for good companies, and I'd say we look for companies that have an openness to keep getting better. I mean, I don't think any of you or any of the companies that have joined Kodiak or any of these others, we've all been successful because we have changed and adapted and grown and evolved. And so to think that you would do a transaction like this and there wouldn't be any change, well, that's just not going to happen. But I think we want to be partnered with people who want to keep getting better every single day and realize that, hey, we're in this local, dynamic, unique market. Things change, things happen, new competitors come in, products change, the needs of your customers change, and so let's all keep working together to figure out how to address those issues every day.
We're looking for companies that are humming along as well. We want them to be positive to our balance sheet, especially positive to our balance sheet. But the other thing that happens is that when you are introduced to a prospective seller, that conversation may take up to a year before you shake hands and sign on the dotted line. What we're asking them to do is keep doing what they're doing. You're a good company, keep doing it. I don't want to get in your way.
Yeah, I agree, especially with what Ruben said. We have occasionally bought some underperforming assets, but typically we prefer companies that are humming along, companies that are busting at the seams and need basically a capital partner to come in and, hey, let's build a trust plan. Let's increase the size of my fleet or whatnot. So definitely prefer the business that are really rocking.
The question came up, and it was one that I was planning to ask as well. Under the new tax code changes, which, I attended a presentation recently on the tax code changes, and at the end of the presentation, they were kind enough to send someone around to wake us up and say, it's over, it's time to go home. It was very tough and very detailed, and I don't think a lot of people fully understand the tax code yet and what it's going to mean. But as active acquirers, and to the extent that you've gotten your hands around it, what do you think the tax code changes will mean for your, not just for your business, but more specifically for your acquisition appetite or practices or anything that you can share with us?
From our standpoint, we may be a year away from being active again in M&A, we'll see, but I don't think it's really going to change our our appetite once we're there. It did change some decisions we made in the fourth quarter from a financing standpoint. But no, from an M&A standpoint, I don't see it.
And in terms of the financing changes that you made, not to get into that, but is it overstating it or oversimplifying it to say that you wouldn't have done those things if they weren't the best long-term outcome? Obviously,
All we did was pay some debt off early in Q4 so we could get the full interest deductibility. We pulled all that interest into 2017. Had we not, the tax reform would have capped how much interest we could deduct. So it was just a cash flow decision. If we paid it off early now, we're going to come out ahead by August of 18 from a cash flow standpoint.
Oh, right, yeah.
I think you're right, Michael. It's a difficult thing to understand, and we're early in that game. Somebody mentioned yesterday the IRS is publishing daily explanations of different points throughout that whole bill. But I think as an acquirer or as a seller, the impact is similar because we both have to look at, as Chad's talking about, how does that impact how we think in terms of cash? How do we think in terms of dividends? We're a small family-owned company. We've got to look at dividends a little differently now. So there are a few things that will change, but I'm not sure exactly what that long-term impact is going to be.
I think overall it's a net positive for the economy, which means it's good for our business growth, and that's good for for acquisition opportunities. But I don't think it fundamentally changes certainly the way we look at things.
Yeah, I would say the same. It doesn't change really anything for us as far as acquisitions go.
Okay. In working with companies that I have made the decision to approach the market and sell their business, we have learned that outside of their family, their business is the single most important thing in their life typically. Maybe their family and their faith. Next would be their business. How do you get a selling owner comfortable with the fact that they're handing the baton to you? There's no line in a purchase agreement I've ever seen that says, we promise we won't change anything. We promise we'll keep everybody that you've got here. We'll get, everything will be the same. You don't even have to worry about it in your retirement. How do you give a business owner comfort on that point of the legacy? Your legacy is a little different than theirs. Your culture might fit but be different. How do you get a selling owner comfortable with passing that baton?
Yeah, again, I think it's transparency. And gosh, we've seen, you're right, most owners are passionate about their business and they want to make sure their people are cared for. So especially in some of the smaller deals, if we need to go person by person with the owner and say, here's the role we see each of these people playing post-close, here's what's going to happen the first 30 days, here's what's going to happen the first 90 days. I think as long as you can just be clear and concise and transparent, that's, in my opinion, that's all you can do. And in some cases, they don't like what they hear. In many cases, they do. But what you don't want to happen is there be some miscommunication. And right out of the gates, day one, there's friction because that's not good for either party.
I think it's also important that they're talking to somebody in the business. It's not like we're McDonald's or
Sure.
The legacy is somewhat intact, especially if we keep the name on the door. And from an employee standpoint, they're still going to pick up the phone and say the same thing they said yesterday. So there are those issues, but I think it's whoever we're talking to has to trust the four people that are sitting up here. So, I mean, we have to have a reputation that we mean what we say and say what we mean. And as I think Ruben and Chad said, talk to some of the people that we've acquired. Feel free to do that. As a matter of fact, in our second deal, they spent a day with the man on the first deal. And obviously it worked, so he must have said the right things. And that didn't cost anything. And I don't mean that in a funny way.
Sure.
The fact of the matter was, we took care of him and his employees, and he was more than willing to say, this is what happened, here's how it happened, here were some of the pitfalls, but here's how they overcame them.
Mm-hmm. Good.
I mean, I think you guys heard, agree with what you've heard, and I think there's a statement about or phrase about trust but verify. So as Dave said, you've got to be able to trust the person you're talking to and what they say their vision is and what they say their culture is and all those things. But then you've got a chance to verify it. And, as Ruben said, I think he said 30 some acquisitions over the last several years. We've done 14. We've got 1,900 employees. I'm sure you've got a lot more. But those were all, for both of us, I know, those were all acquisitions. Those are a lot of ways to verify what that experience has been and verify that you should trust what you've heard.
First off, everybody we're talking to has some sort of interest in selling usually. And so they're kind of stepping in and we're stepping in. And I have the same conversation with every ex-owner. And I went to work for my father-in-law and he sold his business. And when he sold his business, it was more than his life. It was his life. And it killed him for a year. He hated me because I took it over. But I tell that story to every ex-owner because every ex-owner says, yeah, I'm ready. And they're not. Most of them are not. Some of them are, but most of them are not. And things do change. Chad said it. You can say things aren't going to, that's not the case. Things do change, even if you pay weekly and they pay biweekly or the opposite. That's a change for employees. There's certain things that do change. Might be small, computer system or whatever, but we also transparency and being honest and upfront. And that really helps. But I do have the same conversation with every owner.
Great. We're going to take some audience questions. Craig, did you need some? Okay,
And
go
I
ahead.
did have one question from the audience
Sure.
that was passed along to me, and that is the searching, the hunting for good candidates. When you're trying to learn more about them, how do you do your searching? And in particular, for example, do you look at their social media to find out how they treat their employees? Do you do that sort of stuff, or is it all just numbers?
So let me add on to that another audience question, which was, do you see acquisitions getting harder or easier to find in the next couple of years? So both how you're doing your searching, and do you think it will be easier or tougher?
So we have two business development guys. One's a VP and one's a director of business development. That's their whole job. And they're both ex-owners. They both sold their businesses to us. And most of the people that they call on, they know. We have an active database. It's about 224 names on it. And then we have it in sections of who we've talked to, who we've submitted LOIs to, who we've got information from, and it's updated weekly. We're an acquisitive company, and so we are very much in the search and in talking to people all the time. And I think David said, it might take a year, it might take 2 years. Somebody might not be interested now, but they may be later, and we keep in contact with them. It's not all numbers, not even close. It is relationship with customers, with other peers. It is things, and we keep those relationships going.
Yeah, it's certainly a lot more than numbers. I think you've heard everyone up here say time and again how much it's about culture and leadership and people. But so, absolutely, you look at anything you can to learn more about that business, to get smarter about that team. So it's, we've certainly looked at social media and websites and all those kinds of things, how they advertise, what they communicate to their customers about who they are. We've looked at how they give back to their community, just to understand the dynamic of, what are these folks about? We have the opportunity to independently and unobtrusively talk to customers, we'll do that. We talk to the supplier community to try to learn about people, not in terms of, we're thinking about acquiring your vendor, tell us about them, but just in terms of learning about the reputation that business has locally.
Excuse me, because we're a regional supplier, we know the people in our region. So we don't really have to do a lot of research. The one point I would make, however, is that the due diligence process occasionally gets a little intrusive from the owner's perspective because we're there, we're looking through filing cabinets, we're looking at computer reports, we're talking to people. That may be misunderstood. We're not trying to find something, we're trying to validate things. And I think that's an important difference from a due diligence point of view. But now we know the dealers in our area. So, I'm networking right now. There's a guy next to me. I'd like to buy a couple of his yards. So.
Yeah, I agree with what Dave said. We've got the usual channels, right? We all know brokers within the industry and things like that. But a lot of our best leads over time have come from those local market relationships where one of our GMs has known this family for years. He's competed against them for years. And you get leads like that. And those are usually some really good leads because that potential seller would not be reaching up to to us in Dallas, for example, if he didn't like some of the things he had heard and learned about the company from the local GM in that market.
We're hearing a lot about the labor shortage. I want to combine a question about the labor shortage with a question about sort of management talent and white-collar talent too. So thinking at both levels in your various organizations or main company right now, how are you seeing the labor market? Is it getting any better? Is it still tight? Just how can you characterize labor and management talent availability? We'll start with you, Ruben.
Yes, it is still tight, more for our contractors than it is for us, but yeah, truckers are a big deal, and we're having to pay more. But it's still not, it's not hindering our business, it's not hindering our growth. I think there are some challenges with contractor labor. They're having to pay more as well, and having a hard time getting it. And as far as management talent goes, in our case, I feel very fortunate that we have a pretty deep bench. And as I said before, a lot of ex-owners have had a lot of really good people who have come up, and we have a lot of opportunity in the business, and so our bench is very good.
Yeah, I mean, I'd agree on the labor market. It's certainly, it provides headwind and moderation of growth. I think the growth that could be out there, I think it's much more a factor for most of our customers than it is for us. But it's always fine. It's always a challenge to get great people on your team and then to retain and develop and help them grow. So I think that's always a critical part of what we're trying to do from a growth perspective.
I agree. That's a key competency, is to be able to develop people. We have great people. We just don't have enough of them. So, and that's why, from an acquisition point of view, we're looking for the acquired company to have some talent that we can utilize.
Yeah, we've seen obviously tightness in drivers, and then the labor shortage out on job sites. The good and the bad, it's increased the demand for components, roof trusses, and things like that, but it's also squeezed our design capabilities, so truss designers are in high demand. From a management standpoint, you know, we've spoke for years that, hey, this isn't a sexy industry. Most kids coming out of college don't think, man, I want to get into home building, but so we're taking a harder look at that and looking, you know, across our 400 locations and really starting to analyze, okay, how many GMs do we have that are over 50 years old, et cetera, and really trying to amp up our efforts from college recruiting and then internal management training to continue to build our bench strength.
Feel free to make this a quick answer if you want, and so we can get some more audience questions. An earnout is, for those who might not be familiar with it, a payment that would happen over time if a company that's been acquired achieves a certain benchmark of performance, sometimes revenue-driven, sometimes EBITDA-driven. How often do you use earnouts in your acquisitions, and do you have any particular color you can give us based on your answer?
Zero.
Zero. Any particular reason or bad experiences or?
It causes confusion usually. I mean, there may be synergies involved, there may be consolidation involved, there may be conflict with the numbers, so I'd rather not.
I mean, I'd agree with that ideally. We've used them in probably, I don't know, 15% of our transactions that we've closed. And usually, you know, we try to keep them, if you have to do it, to get that alignment and to get something done, I think it's an option, but I think you got to keep it as simple as you can. Number one, and usually where it's actually worked successfully for us is where we had a seller who was incredibly adamant and confident about an outlook that was just really hard for us to get our arms around. And so I think that's the right situation where you say, okay, well, let's agree on what we do if that happens, but we're all having a hard time agreeing on if we think that will indeed occur. So we've used it on a limited basis, but really in situations like that.
We've not used them. I'm not in favor of them. I think they only work if the owner stays and if he trusts you, because he's on your back from a financial point of view. So he has to be able to understand what our numbers look like. What does our column of numbers look like compared to his, because it might not be the same. So yeah, it takes an incredible amount of trust between those two parties.
Yeah, same. I can't think of one instance where we've used one. There's enough going on post-close, and earnouts can just create some friction that's just not really necessary.
I've had a request from the audience to deconstruct our inning metaphor and answer that question in terms of years. Since we all measure our businesses in years rather than innings, we'd like to know how do you see, how long can this continue? How much more growth, good times do we have ahead?
It wouldn't surprise me if we have another 4 years of just the steady growth that we've seen over the last few.
We look for 3 to 5.
In 2011, when we started Kodiak and started raising some capital, we told our very first investors that we thought they should plan on being invested for 10 years at least in Kodiak, because we thought it was going to take that long for the industry to really recover fully. I think that's still our view.
I think that 18 and 19 are going to be quite good. I think, and this is just my view of what things I've seen, but I think 20 might be a little bit of some flattening out. I do.
Okay. One of the things that typically takes place in an acquisition is that in order to enhance their returns, a buyer will introduce debt in the purchase and fund part of the purchase with debt. We frequently encounter business owners who maintain no long-term debt almost as a badge of honor and a point of discipline. How do you get a business owner comfortable with the fact that after an acquisition, their business will be covered by a certain amount of long-term debt, and how do you get them comfortable with that risk increase relative to the business?
I guess for us, it's a little different as a public company. The capital typically has not been much of a concern for the sellers. Obviously, in the downturn, we were all concerned about the availability of capital, but typically not an issue for us.
Our owner loves to use other people's money. So debt is something that we live with every day.
Yeah.
And we do talk to the owners of the acquired companies about that. How we fund our business, how we finance our business really is our point of view. We can show him financial statements. So, and we are,
I'm sorry, did you mean to say you show them your own financial statement?
we're willing to, yes.
That's
I
interesting.
mean, we're going to be partners here pretty quick, right?
Right.
So, but the other thing is we're under bank covenants, and we haven't triggered a bank covenant in years. So, and would welcome them talking to our banker.
Yeah, I mean, similar things. We think it's our capital structure. We try to be just as efficient and prudent with that as we do with anything else, in the business, working capital and CapEx. We're all trying to do things to maximize the value of the business, and part of that is when there's an opportunity to utilize, financing that's really attractive, but still prudent and will support kind of the long-term goals of the business. We're going to do that, and similar to what Dave said, again, in many of our cases, a seller becomes an investor in Kodiak in that transaction. So we certainly are going to share our financials and our outlook and what we're doing and why we're doing that, so that they can get a handle on that and can get a confidence level in that.
Right, and like Chad, our debt is public, our financials are public information, so it's easy for anybody to see that. I'm on the more conservative side. I've been with 3 private equity companies who are not conservative as far as debt goes. So sometimes the debt has gotten high as a private and even public. But my goal is to, I have certain goals to get the debt levels down. And it really hasn't come up in an acquisition as far as you guys have a bunch of debt, or you have some debt or more debt than I have. That's a problem for me. That's never been a conversation that I've had.
Okay. I'm going to combine 2 of the audience questions. One refers to the fact that deal heat, which is just that frenzy and desire to get an acquisition completed once it's begun, almost regardless of whether it makes economic sense anymore. Deal heat can happen. Have you ever found that it was just, the inertia was there, but things presented themselves and you said, you know what, this is just too overdone, let's just step back, number one. And number two, have you ever stepped away from an acquisition because there was that single strong, almost paternal or maternal business owner who just seemed to pervade so much of the organization and be such a force on their own that you didn't think you'd ever be able to unbundle that? So have you stepped away for either of those two reasons?
So I'm going first.
Yes, please.
So after an LOI, we've not stepped away from any acquisitions. And the deal heat is, I think it's been said up here before, is transparency and communication is very, very key. And so we try to tell everybody, look, here's what it's going to be. We do a quality of earnings on every business we buy, whether it's one branch or 100 branches. You know, PwC or Grant Thornton will come in and we tell everybody that. Your numbers are great, your CFO or controller, that's fantastic, but we're going to do a quality of earnings on your stuff. From PwC is going to come in, and most of these guys probably do that too. But just as long as everybody knows what's happening, our HR person comes in and there's a sheet of things that we tell, this is what we need and this is what's going to happen. So I think the transparency and communication is really, really key in it, and it seems to help a lot.
I think, if you think about just your day-to-day business, I think we've all had that big project that we bid on, and then, you're in that dialogue with the customer and their potential customer, and it keeps getting whittled away. Your profit keeps getting whittled away at it, and, you get to a point where you're going, well, is this even worth doing anymore? Are we going to make any money? Customers, whittled my margins down, the project is getting more complicated, but geez, I've put so much time into trying to win this bid. I think the acquisition process can be exactly like that, and I think when those things happen, I know, we've had a few times where as we got in, things were just changing, and well, it doesn't look as good as we thought it did, and for all that, Ruben talked about some of the tools you use to figure that out. Yeah, I mean, there have been, one or two times where as we got in there and really did that diligence and understood the dynamics of the opportunity, it just wasn't what we thought it was going in. And at some point, you've got to have that discipline to say, I'm not going to do something that impairs or hinders the value of our business. So certainly we've done that. I think the second thing you asked, Michael, on kind of big personality kind of I think was the way I kind of interpreted it. Now I don't think we've had anything like that, but again, as you've heard everyone say up here, we're certainly more about partnering with folks than we are just buying their assets and then getting to work and replacing that. So I think again for a situation like that where we've got and we've have some fantastic leaders that have joined our organization through acquisition. We've looked at those as opportunities to leverage that person and make a lot of our younger and less experienced people better by learning from them and being exposed to that leadership.
Acquisitions is a game of patience on both sides. I think one mistake that's made, I like Ruben have not walked away once we've had an LOI in place, but one mistake that a seller makes is that he puts too much responsibility and too much authority in the hands of his advisors, and he almost takes a back seat to that process, when in fact they need to understand the legal agreement, they need to understand the tax consequences, they need to understand all of those things that are being worked through versus allowing, certainly you need advisors and they're important to the process, but they can't be the process.
I can think of a handful that have fallen apart due to the quality of earnings. And it was basically the numbers kept changing. And at some point, as Steve said, yeah, you can lower the price, but at some point you get to where the trust has fallen apart. And it just makes sense for both parties to walk away.
In the interest of time, I'm going to ask on this one if you could just give me a yes or no answer if possible. When you buy a company, do you require all of the employees to be E-verified? Ruben, from an immigration and right to work standpoint.
I think it's varied on our deal. I would say it's not. I don't know the answer to that 100%. And I don't want to say yes.
Not necessarily yes on at any rate.
Right.
Yeah. Okay. Steve.
Yes.
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 Okay. Quality of earnings reports. do you require them when you make an acquisition? Yes or no?
Yes.
Was that unanimous? Yes, okay. So then, with 2 minutes left, if you could each, and this is maybe a stretch for the final question, if you could each just list what you see as the key challenges that the industry has to address in the next few years, or the key challenges that we're facing right now, in a more of a bullet point fashion, with maybe a half minute each left, realizing that's a short amount of time. Chad?
Labor's going to be tight. I think that will continue to be an issue. Obviously, today, lumber inflation, but not just inflation in lumber, inflation in all our expense categories. You know, payroll, fuel, costs are going up across the board, and it's going to be a challenge for us to be able to pass those on.
I agree. Labor will be important, especially in the truck driver arena. I think Ruben already mentioned that and Chad as well. That's a tough thing for us because the competition is everybody who drives trucks, not just other lumberyards. So, and there's a lot of, I think the not only inflation in the wood products industry, but also availability. So if we can get it, we can sell it.
I'd just add talent development to the list.
I would add, there's a lot of change in whether it's manufacturing, distributing, even contracting. And I think that's going to continue to consolidate. We're seeing the roofing guys get into the drywall business. USLBM is going public here, and they have a bunch of different businesses and a different strategy about going things. I think we're going to continue to see change, and I think we all have to change with it. And obviously, labor is a big deal. Immigration is a big deal. And you know, we had over 2 million housing starts in 2005, and we have about 1.2 something right now, maybe. So, and we can't get it done.
Very true. Well, listen, thank you all very much for your input. We certainly appreciate it. This is one of the great benefits of coming to the Pro Sales Conference, is that you get to have these intimate discussions firsthand with some of the most active buyers out there in the industry and learn their perspective, and we hope that we've accomplished that today. We certainly appreciate their time. Thank you, everyone.